Another thing I was to do. Ile ni yangu hata iko wapi? Si kuna soft copy. Mwalimu, unajua hii replacement unataka kuenda na question pia. Is it possible?
Questions? What do you mean, questions? Now we are going to look at the questions. We are going to look at the questions.
So the company is interested in the incremental benefit and the incremental cost.
Now the company will be interested with the incremental benefit and what?
Incremental cost.
Incremental cost.
These steps are followed. Saa zile hadi usiku huo
Yeah, we call it technology. It is the technology where we are right now. So therefore, let us proceed. You can ask a question. It is around there. Replacement analysis, that is what we will be discussing. Replacement analysis. And for the replacement analysis, we are saying that this include what? Replacing an old and inefficient asset with a new and more efficient, which is more economical to do what? To operate. Which is more economical to operate. So this is where you are going to replace an old and inefficient asset with a new and what? And more efficient asset, which is more economical to do what? To operate. So we normally say that under replacement analysis, the company will be concerned with incremental benefit and what? And incremental cost. So the company is going to be concerned with incremental benefits and also incremental what? Incremental cost. So you are going to look at the incremental benefit and also the incremental cost, and therefore you compare to see whether you are going to have what? Whether you are going to have any benefit attached to you. So for the incremental analysis to be carried out, the company will be concerned with the remaining life of the asset, which will be equal to the economic life of the new asset. So therefore, for example, let us assume that you have the existing asset. You have the existing asset, and then you have the new asset. You have the existing asset and you have the new asset. So therefore, this existing asset, let us assume, was acquired 2 years ago. It was acquired 2 years ago, and then you find that after critical analysis, that you are told that this existing asset is going to have 5 more years. 5 more years. It is going to have 5 more years, meaning that these 5 more years will be the same as the years of what? Will be the same as the economic life of the new asset, meaning that this asset is going to be used for how many years?
For 5 years.
For 5 years, and the other one will be used for how many years?
For
7 years.
Yeah, 7
2
years.
and then 5. After what? After when we talk about the critical analysis. Then other than that, we have the steps followed. Yeah? Steps followed. Let us look at the steps followed. We have 6 of them. You are supposed to follow 6 steps when you are evaluating. So the steps followed. Number 1 we have is determination of what? Determine what we call incremental what? Incremental initial what? Initial outlay, or what we call the present value of cash outflow. How do we determine this?
So in this case, pardon Malima,
Yes.
you say we've just said that it involves 2 things.
Incremental benefits and
incremental
incremental
benefits
costs.
and incremental. So what are we
Yes.
calculating between the 2?
Right now, we are looking at the incremental cost.
Cost.
Yeah, the cost. How much? So how do we determine the incremental initial outlay? Number 1, this is how we are going to get it. You are going to take the cost of new asset, the cost of the new asset, then you add, if we have what? Installation, the installation cost, you add it. Then from there, if we have what we call the freight charges, you need to include it. Also, you need to include the import what? Import duty, if it is available. Then from there, also we need the working capital. Working capital, also you include it. And then we subtract what? The market value of existing. The market value of existing what? Asset. So therefore, when we talk, remember when we talk about the current, the working capital is given by the current asset minus what? Current liability. It is the current asset minus current liability. And in most cases, this working capital is made up of what? Is made up of inventory. We'll be talking about the inventory under the current asset. And also we have the debtors, or what we call trade what? Trade receivables. Trade receivables. And this is when we talk about the current asset. Then when we talk about the current liability, majorly we are going to look at what? Trade payables. Trade payables. So therefore, for example, if you had an inventory of 150 and you had receivables of 200, and then you had the trade payables of 230, then for you to get the working capital will be given by what? You take the 150 plus 200, then you raise what? 230. And therefore you are going to get a working capital of how much? In this case, we have a working capital of, you take 150 plus 200, then minus what? 230. You get an amount of one what? An amount of 120. You are going to get an amount of 120. Yes, that is the working capital. Yes, ask the question.
In working capital that we are going to use in this case, are we going to consider under the current liability if, for instance, under current liabilities, we have others like what we have in the bank loan, the overdraft.
Yes.
And
So we
any
can
other-
consider them if we are given, but majorly in the financial management, these are what the examiner is going to give you.
Yeah, so I was
It's going
asking
to give
what
you the,
if you're given,
if you are given,
then we will
still you are going to include the other items of the current liabilities.
Okay.
Yes. Then from there, once you get this, you are going to do what? You add what we call the capital what? Capital gain tax. So how do we arrive at the capital gain tax? How do we get the capital gain tax? We normally start with this. The market value of existing, remember this was asset, market value of existing asset. Then from there, we raise the net book value of existing what? The same existing asset. Then from there, the value, if you get a positive figure here, if the value you get here is positive, you multiply by the tax rate 30%, then you get an amount that you will be adding. In this case, you get an amount which you will be adding in this case. So therefore, that's why I was telling you.
What if you get it negative?
If you get negative, you just put here 0.
Zero.
And then the answer that you have up here, you bring it down here. So therefore, our incremental present value of cash outflow, you bring it down here. That is the step number 1. Remember, we have said we have how many steps? 6 of them. That is the first step. You need to get the incremental what? Incremental cost. Determination of the present value of cash what? Cash outflow. Then we go to step number 2. For the step number 2 is you determine what? You determine incremental depreciation. And how do you get incremental depreciation? For you to get the incremental depreciation will be given by what? Incremental depreciation, you take the depreciation per annum of new asset, then you raise what? You raise the depreciation per annum of existing asset. So you take this one minus this one. Yes, the question
The answer
is,
up there is what we get after we've added the capital gain.
After you have added this and this, the output that you are going to get
Is now what is referred to as
incremental value of incremental present value cash outflow.
Determine the incremental depreciation per annum, depreciation per annum of the new asset. Depreciation per annum of the existing asset.
Then, for you to determine incremental depreciation, you are going to take the depreciation per annum of the new asset. Then you raise the depreciation per annum of the existing asset. And then you get incremental what? Incremental depreciation. That is step number 2. The step number 2 is for you to get incremental what? Incremental depreciation. Step number 2 is for you to get the incremental depreciation. Then what about step number 3? For step number 3 is for you to determine incremental what? Salvage value. Step number 3 is you determine incremental salvage value. You determine incremental salvage value. And how are you going to determine incremental salvage value? you are going to take the salvage value of new asset, salvage value of the new asset. Then from there, you raise the salvage value of existing what? Of existing asset. So you take the salvage value of new asset, then you raise the salvage value of existing what? Of existing asset. Unachukua salvage value of the new asset, then also you raise the salvage value of existing asset. The salvage value is what is remaining from the asset. For example, you have this asset. Let us say you acquired an asset at a cost of 2,000. And then you have charged the depreciation of the asset until today, and you find that it has a remaining what? Let us say whatever that you have charged, it has accumulated to 1,800. Therefore, 200 is remaining, and this 200 is remaining. Therefore, it means if you can decide to sell that asset today, you will sell it at 200. That is what we mean by the salvage value or disposal value. Disposal value. What is remaining? What is remaining? So therefore, then you get incremental what? Incremental salvage what? Salvage value. You get your incremental salvage value in this case. Once you have been able to get the incremental salvage value, then you proceed to the next step. Remember that was step number 3. Then we can go to step number 4. So step number 4 is for you to determine what? You determine terminal benefit. Terminal benefit. And how do you get the terminal benefit? You normally take the incremental salvage value, incremental salvage value, then you add what? You are going to add the working capital. You add the working capital. And once you add the working capital, you are going to get what? Total terminal what? Terminal benefit. So we normally say that the working capital at the beginning of the project life is treated as what? As an outflow. So this working capital at the beginning of the project, we normally treat it as an outflow. And at the end of the project, this working capital, we are going to treat it as what? Inflow. So at the beginning, it's an outflow. And then at the end of the useful life, we are doing what? We are recovering. At the end of the life, we are recovering.
But so, it is just the same amount.
Yeah, the same amount. If there is no inflation, then we talk about the same amount.
What if there is inflation?
If there is inflation and then we have yearly basis, then in that case we are going to consider what? The inflation. We are going to consider the inflation. Remember, for us to get the inflation, we normally say that it is 1 plus what? Inflation rate. Then raised to what? Raised to n. Then from there, if we have 5 years, so we have year 1, 2, 3, 4, and 5. So therefore, the inflation for year 1 is 1 plus what? Inflation rate raised to power 1. This is 1 plus inflation rate raised to power 2, 1 plus inflation rate raised to power 3, 1 plus inflation rate raised to power 4, and 1 plus inflation rate raised to power what? Raised to power 5. So you consider the inflation. So therefore, if, for example, you had a working capital of 2,000, then in this case will be 2,000. Then you consider the inflation This one also you consider inflation. Then you will find that those working capitals are not going to be the same. So the working capital that you will have in year one and the last year here is not going to be the same.
I'm seeing you multiplying them. Oh, you're considering just by year, not that you've multiplied.
Not that I have
them
multiplied. I'm just considering per
year.
So the rate. But we are going to do a question with inflation, and then you will see how we adjust. It's because we have done with others about the how you incorporate what? Inflation. So we have one we talk about the general inflation, and sometimes we have a specific inflation. Then that is step number 4. Then we go to step number 5. For step number 5 is you do what? You determine what?
Annual cash flow.
Yeah, you determine incremental annual what? Annual cash flow. You determine incremental annual cash flow. And how do you determine the incremental annual cash flow? For you to determine incremental annual cash flow, in this case, you are going to consider what? Incremental what? Incremental annual savings. We talk about annual savings. Then from there, you consider what? Incremental what? Cost. We can talk about cost savings, although it's the same case. So also we can talk about incremental costs. For the incremental cost, you are going to do what? To deduct. And once you deduct, the output you will get here is what we call the earnings before depreciation and what? And the tax. But in some cases, you can find the examiner giving you what? The examiner giving you earnings before depreciation and tax. But in this case, is going to give you for the existing asset, and also he gives you for the new asset. Whereby, for example, you are told that we have the earnings before depreciation and tax for year 1 of the existing asset. Maybe you are given 2,000. Then for the new asset, you are given 2,500. So therefore, our incremental earnings before depreciation and tax will be how much? Will be 500. Then you compute for all the years which are available. If you are given 5 years, you compute for the 5 years.
Separately, after getting, for instance, first year you've got 500. Second
year you go for the second year. Maybe it's the second year. Here you are given 1,500. Here you are given 2,100. So therefore, you have an extent of how much? 300. This 300 will be incremental earnings before what? Depreciation
so I'm asking,
and tax. Yes?
I'm asking, in that case, we're going to go per year.
Yeah, we go per year based on annual basis. That's why we are saying determine incremental annual cash flows. So that is per year basis, annually.
And what is the difference between incremental annual savings and incremental cost?
Incremental costs. Yeah, you might find that initially, under the existing machine, the cost was how much? The cost was 2,000. And when you incorporate the new machine, the cost is what? The cost now is 3,000. So meaning our cost has increased by how much? By 1,000. So therefore, this cost we need to incur here. The good thing you will find is that the savings also has increased, or you are going to have a revenue which is more. So for example, initially using the existing asset, maybe you are generating a revenue of 50,000. Now you find that it has increased to how much? It has increased to 80,000. Yes.
That is what I wanted to mean. That in the other case, you are getting the profit, the amount that maybe extra coins.
So even you can start with the incremental profit, then you have some savings. You see, these savings will arrive if you avoid the wastages. wastages. If you avoid the wastages, maybe the output, or we can talk about the production. Maybe this machine was producing how much? 2,000 units. Then this one is producing more units compared with what was produced initially. Yes. So once you get this, I normally like to use the formula. The formula is a bit accurate. I normally like to use the formula. So how do you get now the annual? Remember, you have not gotten the annual what? Annual operating cash flow. So for us to get now the annual operating cash flow, you normally get it. You take the earnings before what? Depreciation and tax, 1 minus T, then plus depreciation tax shield what? Depreciation tax shield benefit. So you take into account the depreciation tax shield what? Depreciation tax shield benefit. Depreciation tax shield
Annual operating
benefit.
cost.
Yes. Yeah. Annual operating cash flow. Annual operating cash flow, not cost. Cash flow is given by the earnings before depreciation and tax, then 1 minus T plus depreciation tax shield benefit. So how do you get the depreciation tax shield benefit? It will be given by the depreciation. You take the depreciation expense, then you multiply by the tax rate. You take the depreciation expense, you multiply by the tax rate. Depreciation expense you multiply by the tax rate. So that is how you get the annual operating cash flow. And once you are able to compute this, now the last step is for you. You do what? Evaluate. You evaluate using what? Net present value. And how do we get the net present value? It's given by the present value of cash inflow. Then you less the present value of cash outflow. Is the present value of cash inflow, then you less the present value of cash outflow. That's how you get the net present value. If NPV is positive, you should what? You should replace the asset. If the NPV is negative, you should not replace what? The asset. That is how you come up with the conclusion. That's how you should come up with the conclusion in this case. So therefore,
Nini you will be given mwalimu?
yes,
PVCIF. Present value of cash inflow.
cash inflow, you are going to calculate, you are going to discount these cash flows for you to reach out at the present value of what? Present value of cash inflow. That's why I want us to do the question for you to get that explanation that you are looking for. Now we can do illustrations so that you can get it clearly, so you can get the explanation.
Tuanze huku juu, what we've been looking
clear.
for, which we've got, is the present value cash outflow.
The present value of cash outflow is this one, incremental present value of cash outflow. So that one is computed in the first step.
Yes.
Then from there, the second step is for us to determine what? Incremental depreciation. So this depreciation incremental is the one that we are going to bring it here. Then we multiply by the tax rate. So if we can go through a question, I think it is going to come out
Earnings after tax.
clear.
Which tumepata hapa chini.
Yes.
These are earnings after tax that we
Earnings after tax is like from this part to this part.
Ndio nauliza.
Yes.
The essence, what is it going to help us with in this case now?
It is going to help us to get the annual operating what?
Cash flow.
Cash flows. Annual operating cash flow. Annual operating cash flow. So that is the format.
Okay.
This is just the format. So therefore, let us go straight away to a question of what? November. Is it November 2017? Let us look at that one of November 2017. And then also we are going to look at another one. So we start with that one. Hope you have the AFM.
Advanced Financial Management 2015 to 20.
The advanced financial management. We have advanced financial management. We go to
2017.
Yes, let me see, in November 2020. Then we are November 2018, May 2018, November 2017. You will find it in page, on page. On page, this is page 101. Page 101. Question number 1B. Question number 1B. 101. Question number 1B. Viwanda Limited. Are you there? Yeah, therefore, question 1B is the question I would like us to do what? To go through, and then we see how can we adjust this question. How can we do it? Let us look at it. We look at it and we see, are we able? Are we able? Are we able to adjust? So this is what we are told. This is what we are told from our question. So we are told that Viwanda Limited is considering purchasing a machine at a cost of shillings 40 million. The company will incur an additional shillings what? 20 million to modify the machine for special use. The machine is expected to have a useful life of 3 years and a scrap value of shillings 15 million after 3 years. The investment will require an increase in working capital of shillings 2 million at the beginning of its useful life. The additional investment in working capital will return to normal at the end of the machine's what? Useful life. The machine's purchase will not affect the revenue, but it is expected to save the company shillings what? 25 million each year in before tax operating what? Costs. Mainly labor. The company tax rate is 30% and the company's cost of capital is 10%. So required advise Viwanda Limited on whether to buy the machine. You advise Viwanda Limited on whether to do what? Whether to buy the machine. Whether to buy the machine. That is the question that we have. So therefore, let us see how we can adjust this. So step number 1, let us determine what? We determine the present value of cash what? Outflow. We determine the present value of cash outflow. And how are we going to determine this? Our shillings are given in million. Very important. Our shillings are in what? In million. This is what we have. So we have the cost of the machine. How much do we have as the cost? We are told that
machine
Rwanda
is
Limited is
40.
considering purchasing a machine at a cost of how much?
40 million.
So we have the cost of the machine. The cost of the machine is how much? It is 40 million. Then the company will incur additional
20 million.
Shillings 20 million to modify the machine. So we have the modification. Modification what?
Cost.
Cost of how much?
20 million.
Of 20 million. Then from there, the machine is expected to have a useful life of 3 years and a scrap value of shillings 15 million after what?
3 years.
After 3 years. The investment will require an increase in working capital of how much?
2 million.
So we have the working what?
Capital.
Working capital of 2 million. Then from there, how much are we going to have? This is just an acquisition question. It is an acquisition question. You are just acquiring. So therefore, the total will be
62.
62. For this question, we are not replacing, but we are just acquiring a new what? A new asset. Yes, we are acquiring a new asset. So in this case, we want to evaluate to see whether it is worthwhile for us to acquire the new asset. So this will be our present value of cash outflow. So you are going to just take the cost of the machine plus the modification cost plus what? Plus the working capital. Then from there, we can determine what? Let us determine the depreciation. So when we determine the depreciation, in this case, we can use what? The straight line. How do we get the depreciation? Based on the straight line method, depreciation will be given by what? The cost minus salvage what? Salvage value. Then we divide by what? The useful life. So therefore, our cost will be how much? Our cost will be, the working capital is never part of what? Of the cost. So the cost will be this plus what? Modification cost. So it is going to be 60. Then we raise the salvage value. If we decide to dispose, how much are we going to dispose? We are told that the machine is expected to have a useful life of 3 years and a scrap value of how much?
15.
Of 15. So we are going to dispose at 15. Then we divide by the useful life of how much? 3 years. So therefore, how much? 3 years, how much will be our depreciation? So it will be 60 minus 15. Then we divide by what? By 3. And we are going to get how much?
15.
So in this case, we are going to get 15. Yeah, we will get 15 million. This will be our depreciation. Once we get the depreciation, now we can get the annual operating cash flow. Because if we continue, this is what we are told. If we proceed, we are told that this is what we are told. We are told that the machine's purchase will not affect the revenue, but is expected to save the company how much? 25 million each year in before what? Tax operating cost. Mainly what? Mainly the labor. So in this case, we are going to have what? We are going to have our earnings before tax. Earnings before tax of how much? We are given of incremental earnings before tax of how much? Our incremental earnings before tax of how much? Of shillings 25 million. 25 million. So how are we going to get our annual operating cash flow? Remember, our annual operating cash flow we said is given by what? Earnings before depreciation and what? And tax, 1 minus T. Then from there we add depreciation, tax sheet what? Tax sheet benefit. So therefore we are going to assume this figure as our earnings before depreciation and what? And the tax. So we are going to have 25, then into bracket 1 minus, are we given the tax rate?
0.3.
Yeah, 0.3. Then we add depreciation. Depreciation is the one that we have computed, which will be 15. Then we multiply by 0.3. So therefore, our annual operating cash flow will be how much? Annual operating cash flow is going to be how much? Our annual operating cash flow will be how much? How much are we going to get in this case? It is going to be 25. Then we multiply by 0.7 plus what? 15 you multiply by 0.3. And therefore, in this case, we are going to get an amount of how much? An amount of 22. We are going to get 22 in this case. 22 what? 22 million. We will get 22 million. 22 million. That is what we are going to arrive at. We are going to get 22 million. Confirm whether it is true. It is true. Then from there, once you are able to join, to have this, then we can get what? We can get the NPV. How do we get the NPV? It is given by the present value of cash inflow minus present value of cash outflow. And you can see what we have computed is an annuity, what we call the annuity. So if we have an annuity, how do we get the present value of annuity? The present value of annuity is given by the annuity, then you multiply by the present value interest factor, annuity R percent, N is the number of period. So therefore, it is going to be the annuity you have gotten how much? 22. Then we multiply by this annuity factor. The annuity factor will be 1 minus what? 1 plus 0.1 raised to -3. Then everything we divide by what? We divide by 0.1. So therefore, it will be 22 times. Let us get this factor for 3 years. The factor will be how much for 3 years? The factor is going to be how much? It is 1.1 raised to -3. Then 1 minus the answer. Then from there you divide by 0.1. So therefore we are going to get an amount of what? 2.4869. I don't know whether that is what you have gotten. Then from there we do what? We take 2.4869, then we multiply by 22. And we get an amount of 54 point what? 54.71 shillings. In what? In million. In million. Shillings in million. And once we have gotten that, now we can get our net present value. Net present value. But remember, also we need to add what? That is the present value of what? Of annuity. There is a terminal benefit. So also we need to calculate the present value of terminal benefit or the salvage value. It is going to be the terminal benefit. You multiply by the present value interest factor, R percent, N. So we have a terminal benefit of how much? The salvage value. This salvage value. This salvage value. So it is going to be 15. Then give me the present value. This is the same as 1 plus R raised to negative what? Negative N. So it is 1 plus 0.1 raised to negative what? Raised to -3. Raised to -3 in this case. So therefore, how much are you going to have? 1.1. Then you raise to -3. You are going to have how much? 0.7513. So it will be 15 times 0.7513, which is going to give us how much? It will be 15 times 0.7513. So we are going to get 11.27. So here we have 11.27. Then from there we get the total what? Total present value of cash inflow. It is going to be this one, 54.71 plus what? Plus 11.27. So therefore the total will be how much? Shillings. The total is going to be how much? The total will be 54.71 plus 11.27. Then we are going to get 65.98. So here we have 65.98 million. Then from there we can get our net present value. Yes.
In determination of terminal benefit,
Yeah, the terminal benefit.
we said that it is the salvage value, that is the incremental plus the working capital.
Oh, we forgot about the working capital. We only took the salvage value. Yeah, that means our working is wrong. So therefore it will be the salvage value, you add the working capital. So therefore it is going to be how much?
17.
It will be 17. It is going to be 17, not 15. So therefore it will be 17. Then you multiply by 0.7513, which will be how much? It is going to be 12, not 11. It is going to be 12 now. It will be 12 point what? 0.77. So here we have 12.77, and therefore we are going to have how much? It is 54.71 plus 12.77, and therefore we are going to get 67.48. So let us get the NPV. It's given by the present value of cash inflow minus present value of cash outflow. So it will be 67.48 minus how much? This one was 62. So therefore our NPV will be shillings what? Minus 62.
5 point.
It will be 5.48 million. 5.48 what? Million. We are going to have 5.48 million. So that's how we are supposed to compute that. That is how you are supposed to do what? To compute that. Unless there is any question pertaining that. Any question about that? So you can look at that, and then you can ask any question that you want, or where you are not comfortable.
where you have an issue, I'm here. So you can put your concern, and your concern will be addressed.
Present value annuity.
Mhm.
Present value annuity.
Yes.
Okay. The conclusion that this is an annuity is because tulichukua 3 years.
It's because what we were able to get from the question is just an annual operating cash flow for 1 year. So that's why we classified it as what?
Annuity.
As an annuity. So it will be an annuity for 3 years. It means that each year they were getting an annual operating cash flow of how much?
Of 25.
Of 22.
Of 22.
Yes, of 22.
So present value annuities now. Annuity. Okay.
Yes, let us look at another question. Now this is a purely replacement, not acquisition. This will be purely replacement. And the question I want us to look at.
What did you mean before you mean that? By this actual?
Yes. That one I think is a mix-up from a student. It was a different question.
A different question.
Yes. That's a different question. So let us look at another question, May 2015, question number 1B. May 2015, question number 1B. That is the question I would like us to go through. From the other past paper, you have the other one, the one that starts from November 2019. The other past paper, which is from November 2019 to 2002. Yeah, 2019 to 2002.
But
if you don't, I can share it.
See.
Yeah, I don't think May will be found in our.
Oh, this
past
is 2015 December.
Yes. So I have shared the other paper. Let us use that. Let us use that one. Are you there in May 2015? It is question number 1B. Question number 1B. May 2015, question number 1B. Page 50. Page 50.
Chuma.
Yeah, Chuma Limited. So we are told that Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of shillings 50 million. The machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. The machine could be disposed of immediately at shillings 35 million. The new machine will cost shillings 80 million with a useful life of 5 years and unexpected terminal value of shillings 5 million. With the introduction of the new machine, sales are expected to increase by shillings what? 25 million per annum over the next 5 years. The contribution margin
is expected to be 40%, and the corporation tax rate is 30%. The operations of the new machine will also require an immediate investment of shillings 8 million in working capital. Installation cost of the new machine will amount to shillings what? 6 million. Depreciation is to be provided for on a straight line basis. The company's cost of capital is 12%. Required, advise the management of Chuma Limited on whether to replace the machine. You are supposed to advise whether they should replace the machine. Yes, you are following the steps now. The 6 steps, and then you do what? You advise. You follow the 6 steps, and then you advise whether they should replace. So step number one we say is determine what?
Determine
Incremental
outflow.
present value of cash outflow. Let us determine it. And how do we determine? Our shillings are given in what? Our shillings are given in million, so we can decide to operate in million. Shillings in million. So we said we start with the cost of new machine. The cost of the new machine is how much? We are given how much as the cost of the new machine? The cost of the new machine, we are told in the second paragraph, not the second paragraph.
The existing machine is worth 3 years at the price of this, and the machine is expected. The cost of the new machine will be 80.
It is 80. Then from there, do we have installation?
Installation cost is nothing.
Installation cost of how much?
Yes.
The last paragraph.
The last paragraph is
The second last. Second last, we are told that the contribution margin is expected to be 40% and the corporation tax rate is 30%. The operations of the new machine will require an immediate investment of shillings what? 8 million in working capital. Installation cost of the new machine will amount to shillings 6 million. Will amount to shillings what? 6 million. We are having 6 million. We have 6 million. Isn't it? From the question, we are having 6 million.
installation cost 6 million.
Yes, then from there we have the working capital. Working capital, we are given a working capital of how much? 8 million. The same
We
paragraph.
also require an immediate investment of 8 million in working capital, yes?
Yes. Then from there, we don't have anything else, so we are going to less what? The market value of what? Existing what? Existing machine. How much? The market value of existing machine. You are told that the first paragraph, Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of shillings 50 million. The machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. The machine could be disposed of immediately at shillings what? 35. Have you seen that? If we sell the machine today, we are going to sell it at how much? At 35. You are supposed to sell at 35. You are supposed to sell it at 35. That is what we have. Then from there, we add what? We said we add the capital gain what? Gain tax. And how do we get the capital gain tax? We said that the capital gain tax will be given by what? It is going to be given by the market value of existing what? Existing machine or asset. And we have 35. Then we less what?
the net book value of existing what? Existing machine. So let us get the net book value of the existing machine. How do we get the existing machine? The net book value. We are told that Chuma Limited is considering replacing a machine. The machine was bought 3 years ago. So that machine was bought 3 years ago, isn't it? It was bought at how much? 50 million.
50 million.
Yeah, 50 million. They are talking about the 50 million. Then they continue to tell us that the machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. At the end of its useful life. That is the information that we have.
So does it mean that?
So therefore, it is going to take how many years?
8.
We bought it 3 years ago, so it is 8.
Yes.
So let us get the depreciation. Depreciation will be the cost you divide by what? The useful life.
6.25.
Yatupatia ngapi?
6.25.
6.25. 6.25. Then our accumulated what? Accumulated depreciation will be how much? Accumulated depreciation will be 6.25 times what? The period that we have used the machine. We have already used it for
3 years.
3 years. So it will be how much?
18.75.
18.75. Then let us get the net book value. How do we get the net book value? The net book value is given by the
cost minus
cost you raised to the
depreciation.
accumulated depreciation. Cost is how much?
50.
It is 50 minus what? 18.7.
31.
Therefore, how much are you getting?
31.25.
So we are getting 31.25. So our net book value here is 31.25. So therefore, give me the value here.
31.25.
Yes, how much are we getting?
3.75.
We are getting 3.75. And we said if we get a positive figure, we multiply by the tax rate. So when we multiply by 30%, how much are we getting?
1.125.
1.125. Then from there we can get our incremental what? Incremental present value of cash outflow. So this plus this plus this minus this. How much are you getting here? So how much are we getting? So it will be 80 plus 6 plus 8 minus 35.
60.125.
We are getting 59.
Oh.
Then plus 1.125. We are getting 60.125. So that will be the incremental present value of cash outflow. Then the next step is for us to determine what? We determine incremental depreciation. Incremental depreciation. And we said that for us to determine incremental depreciation, we are going to determine the depreciation per annum of the new machine. Remember, whatever you have determined is for the old what? Old machine. Old machine before the critical analysis. Before the critical analysis. This is before the critical analysis. Now we want after what? After critical what? Critical analysis. After critical analysis, let us get the depreciation of new machine. Depreciation of the new machine. Here, let us get the cost of the new machine.
The cost of new machine is 80 million
This
plus
this. So which will be how much?
Plus
86, isn't it?
installation cost 86.
Then we raise what? We raise the salvage. We are told that the new machine will cost 80 million with a useful life for 5 years and an expected terminal value of how much?
35.
5. Not 35, but 5. in paragraph 1. So therefore, the salvage value is how much?
No, the machine is
It's five.
substituted over useful life of 5. Why is this 5?
The first paragraph,
Hmm.
almost the last line. Huh? You are told that the new machine will cost 80 million with a useful life for 5 years and an expected terminal value of what?
Oh, 5 years.
So therefore,
Oh, 5.
depreciation will be how much? You divide by 5. Huh?
81 divided by
Yeah.
5.
How much are we getting? Depreciation of the new machine.
16.2.
You are getting, so we have depreciation per annum of the new machine. How much? 16.2.
16.2.
It's
Yeah.
just 2.
16.2.
Then we need the depreciation per annum of existing, existing machine. So for us to get the depreciation per annum, depreciation of new, not new, but existing machine. Existing machine, you start with the net book value. The net book value, we had a net book value of how much? This is the net book value. We assume this net book value is our what? Our cost.
As at the 3rd year.
Yes.
The beginning of the 4th year.
That 1 point what? That 1.25. Then remember they said it had no salvage value, so we divide by the remaining life. Yenye ni miaka ngapi?
5.
Miaka 5. Unapata ngapi?
6.25.
The same that we have here. Isn't it?
Yeah.
Yes.
Not
We
the
have
same.
6.25. You want to say they are not the same? They are the same.
Oh, so.
Because after critical evaluation hakukuwa na nini?
No
Resale value or salvage value. Kama kungekuwa nayo haingekuwa the same. Yes. So therefore, let us get our incremental here. Incremental depreciation will be how much? Incremental
9.95.
depreciation will be
9.95.
9.95. That is what we have. Then step number 3, determination of what? We determine incremental what? Incremental
So vitu umezishika.
salvage what? Salvage value. We determine incremental salvage value. And how are we going to get incremental salvage value? We take the salvage value,
The new machine.
salvage value of new machine. The salvage value of new machine was how much? Salvage value of the new machine.
It's expected to increase between the 5, the salvage value. The machine with the 5. Huh?
It is 5. Huh?
Yes.
Then we raise the salvage value of existing machine, which is how much?
35.
Which is not 35. 35 is if we had decided to sell today after 3 years. So therefore there is
0.
nothing. So therefore we
Tafiti
get
that nini hiyo kitu ningepeleka 35.
we get what? Incremental what? Incremental salvage value. So this is 5. Huh? Yes. Yeah, that 5 is if we decide to dispose today.
Right.
If we decide to dispose today, we dispose at how much? We dispose
At 35.
at 35. We dispose at 35. That is what we are told by the examiner. Then from there, we proceed. Then step number 4 is we determine what? We determine terminal what? Terminal benefits. So we determine the terminal benefits.
Hizi vitu unazifuata.
Yeah, you follow the steps. You see the figures are just coming. When you
And
follow
if
the
you
steps.
interchange them,
You can interchange them, huh?
the steps,
But ensure you follow the 6 of them.
but you can interchange the steps.
Yeah, there is no.
Sasa zingine bwana umesahau hii nini ile ya kwanza ndio
It is not for you to arrange them the way they are. You can interchange them, but ensure
that all of them are
you
there.
don't jump any step. Yes, so therefore, here you determine the terminal benefit. So the terminal benefit, we have incremental what? Incremental salvage what? Salvage value, which is how much? It is 5. Then you add the working what? Working
So
capital.
incremental salvage value.
Yes.
Suppose salvage value ya old machine. The incremental salvage value sasa yenye inatumika hapa ni ya nini?
Hapana.
Suppose the salvage value ya the old machine ingekuwa hata 3. And then ya new machine 5. So in that case, incremental salvage value inaenda kuwa 5. 2, sorry.
2.
So that is what we will bring down here.
Yes. Hata sometimes inaweza kuwa negative. Unaweza pata hii salvage value yake ni 10 na hii upate salvage value yake ni 18. So therefore ukiresi unapata negative what? So you bring a negative.
That negative ndio unaleta.
Yes, ikiwa negative. Yes. Whatever that you had, got it. So the working capital ilikuwa ni ngapi? 8. Ndio hii hapa juu. Ndio hii. Working capital ndio hii. Ndio hiyo unaleta hapa 8. Alafu unapata nini?
But sasa huku unaiongeza.
Total terminal. Yes.
Inflow.
Total terminal benefit. Of how much?
Of 13.
Of 13. Then from there we go to step number. That was step number 4. Then we go to step number 5. Step number 5 we said you determine what? Determine
incremental cash flow.
Incremental what? Incremental cash flow or cash inflow. Yeah, cash flow, or you can call it the cash inflow. So what we have? That as you are told that the still under number 1, the last line. With the introduction of the new machine, the sales are expected to increase by shillings what? 25. So we have shillings in a million. So amesema sales are increased by what? Shillings 25. So incremental what? We talk about incremental sales. Incremental sales of how much?
Of 25.
Of 25. Then we need what? We can get the variable. Incremental variable cost. Incremental variable cost. So that we can get the contribution. Contribution. We have the contribution. Yeah, contribution is there. Have you seen note the next paragraph? You are told that the contribution margin is expected to be 40%. So if contribution margin is 40%, therefore the variable will be 60%. So therefore, how much are you getting as the contribution? Contribution inaleta ngapi?
60% of what?
Of the sales. So sales times 0.6.
Unapata
ngapi? Unapata 15. Therefore, uchukue 25 minus answer, upate the contribution ni ngapi? Ni 10. But unaweza amua uende direct. Uchukue 8 times C, upate contribution. No one will penalize you for going direct.
Alafu the essence of getting contribution is the cost saving.
Yes. The contribution, that is the incremental contribution. Contribution is arrived when you take the sales minus variable cost.
Yes.
You get the contribution. But now this is incremental after you have introduced what? You have introduced the new machine in the organization. Then from there, do we have any other cost savings? Do we have any other cost savings? Because wamesema the contribution margin is expected to be 40% and the corporation tax is what? Is 30%. The operations of the new machine will also require an immediate what? Investment in working capital. Installation cost of the new machine will amount to shillings what? 6 million. It amount to 6 million.
So therefore hawajaongelea nini? Hawajaongelea anything else. And therefore these our contribution will be the same as our earnings before what? Depreciation and tax. That is the same as our earnings before depreciation and tax. So once we have this, now we can get our annual what? Annual operating cash flow. And we said that for us to get annual operating cash flow will be given by the earnings before depreciation and what? And tax 1 minus T plus the depreciation tax shield benefit. So tuko na ngapi hapa? Tuko na 10. 1 minus what? 0.3 plus depreciation tulipata ngapi hapa, iko wapi? Ndio hii. Tulipata 9 we have 9.95 times what? 0.3. So how much are we getting as our annual operating cash flow? Inakuja ngapi? Our annual operating cash flow 10 times 0.7 jamani, plus 9.95 times what? 0.3.
20.
So we are getting what?
20.8.
I mean it's part 20 jamani.
Plus,
sorry,
nimeongeza
9.985. Mimi napata 9.985 shillings in million. Hii sijui kama wewe unapata. Kwa wewe umesema umeongeza
9.985.
Yes, that is what I'm getting. That is what I'm getting. So again, we are only able to get for the 1 year, isn't it?
Mm-hmm.
And if we are able to get for 1 year, meaning that is what? That's an annuity. So therefore we compute for the present value of what? Of annuity. Yani tusema ni annuity times present value interest factor, annuity R%. So therefore itakuwa namna gani? Annuity tumepata ni 9.985. Then we multiply by, give me this factor, is 1 plus, walikuwa wametupatia cost of capital of how much? The cost of capital was how much? Walikuwa wamesema the last line, the depreciation is to be provided for on a straight-line basis. The company cost of capital is 12. So hapa ni 1 plus 1.12 raised to, is it 5 years? Then we divide by 0.12. So itakuwa ni 9.985 times, give me this for 5 years.
Let me ask you. Huku uli minus.
Si nimeongeza direct. Oh, hii ni minus, sorry. Yeah. Hii ndio nimeweka wrong, na? Inastahili kuwa minus. Okay. That is okay. That is okay. It is minus. So therefore itakuwa ni ngapi? 1.12 raised to -5. Then 1 minus the answer. Then you divide by 0.12. So therefore we are going to get how much? We will get 3.6048. 3.6048.
Hiyo ni power 3.
Gani? This is -5. They said 5 years, isn't it? From the question. Chuma. Yeah, it is 5 years after critical what? Critical evaluation.
3.60478.
So 9 point what? 985. Then we multiply by 3.6048 because you must give your answer to 4 decimal places. And therefore, I'm getting shillings what? Shillings 35.99 million. Then from there we can get the present value of terminal benefit. We said is the terminal benefit times present value interest factor R% N. So the terminal benefit is how much? Ndio hii tuko nayo hapa ni 13. So it will be 13 times what? Hii tunapata 1 plus 0.12, then you raise to negative what? -5. And in that case,
we get how much? It is 1.12 raised to negative what? Negative 5. So the answer will be 0.5674. 0.5674. Then we multiply by 13. And in this case, we are going to get an amount of how much? 7 point what? 7.38 million. 7.38 million. Then from there you get the total. So shillings. This will be the total present value of cash inflow. Itakuwa ni ngapi? 35.99 plus 7.38, and therefore we are getting 43 point what? 37 million. That is what we have. After having that, now we can compute our net present value. Let us compute our net present value. How do we get the NPV now? NPV will be given by the present value of cash inflow minus present value of cash outflow. So the inflow we have 43 point what? 37 minus the outflow we have how much?
86.
Outflow we have 60, not 86. This one, 60 point what? 125. Huh? Therefore, we are going to get an NPV of how much? Negative what? Shillings 43 point this minus 60.125, and therefore we are going to have 16 point what? 755 million. That is how you are supposed to compute that question. And you can see we have followed all the steps. We have followed all the steps. If you forget any, you cannot arrive at the correct output.
Zinakanganya tu hapo katikati.
It's all about practicing. And once you practice, you are going to be there. It is all about practicing. Once you are able to practice, you are going to be there.
Yes. Hello. Yes.
So.
Yeah. Huku mbona ni negative?
Yeah, it's negative.
Negative. Hii pia ni moja kati ya hizo. So I will go try.
That is a different one.
That is a different trend. No, then hiyo pia ni jaribu.
No. That is a different one. That is a different one. So that is how we are supposed to do that kind of a question. So I think for that part, we have touched a good area. I've touched.
So you've not touch on one with inflation.
I've not. Yeah, we have no question on the inflation with the replacement, but we have a question of inflation under what NPV, of which we will be looking at it later. So I think we can look at the real options. Real options. We can look at the real options. Real options. We can look at the real options. So let us discuss on real options. We'll discuss on real options. Yeah, when we talk about the real option, it is an option associated with the real assets that allows the company to enhance or alter the project's what? Or alter the project's value.
Enhance or alter.
Yeah, or alter the project's value with decisions sometimes in the future. With decisions sometimes in what? In the future. With decisions sometimes in the future. Then we have some types of the real option. You can be asked in the exam. Types of real option. Types of real options. Have the types of real options. Types of real options. And for the types of real options, number one, we have what we call the timing options. We have the timing options. And when we talk about the timing options, we normally say or the company allows the company to do what? To delay the investment. Allows the company to delay the investment. The investment. Then also we have fundamental options. Number two is fundamental options. And when we talk about the fundamental options, allows the company to alter its decision based on future what? Based on future events. Allows the company to alter its decisions based on future events. Then number three, we have strategic investment option. Strategic investment options. Strategic investment options. And when we talk about strategic investment options, this follows an opportunity over which the firm has an option if it makes what? If it makes the original what? If it makes the original investment. This follows an opportunity over which the firm has options if it makes what? The original investment. Then we have the replacement option. We can talk about number 4, replacement options. Replacement options. And when we talk about the replacement options, discounted cash flows techniques can assist in replacement to decide how frequently an asset should be replaced. Discounted cash flow techniques can assist in replacement to decide how frequently an asset should be replaced. So when an asset is being replaced with an identical asset, the equivalent annual cost method can be used to calculate an optimal what? Replacement cycle. So when an asset is being replaced with an identical asset, the equivalent annual cost method can be used to calculate the optimal replacement what? Replacement cycle. Then from there, we have abandonment option. We have abandonment, number 5, abandonment options. Abandonment options. And when we talk about the abandonment options, is a situation where the project can be shut down if its cash flows turn out to be lower than expected. We call it abandonment option. And finally, we have the option to do what? To expand. We can talk about the options to expand. Options to expand. Options to expand. This would be similar to an option to delay in that it could, in which could invest what? A certain amount in the project what? Now, and decide later whether or not to do what? To expand. You decide later whether or not to expand. So that's about the types of the real options. So we have the timing, we have fundamental, strategic, then we have the replacement, then from there we have abandonment and what? And the option to expand. So we are going to look at the replacement. We start with the replacement, and I want us to look at the question where we are going to use what? Equivalent annual what? Cost method. Equivalent annual cost method, where we will use the equivalent annual cost method. December 2024. Let us look at a question of December 2024. December 2024. I want us to go through that question. December 2024. AFM, December 2024. AFM.
AFM.
Advanced Financial Management, December 2024. Question number 1C, December 2024. Question number 1C. So we have December 2024, question number 1 what? C. Question number 1C. That is the question I want us to go through question number 1C. Are you there? Yes?
December
2024, question number 1C.
December.
Yeah, question number 1C.
The directors of
Jasiri Limited. Yeah, you are told that the directors of Jasiri Limited wishes to identify the optimum replacement cycle that will minimize the cost of the operating its freight of vehicles. The relevant data is as follows. You are given the age of the vehicles in years. We have the replacement cost. You are given the annual operating and maintenance cost, then lesage value at the end of the year. Then additional information, the company's cost of capital is 10%. Ignore what? Ignore taxation. Then you are told using the annual equivalent cost technique, advise Jasiri Limited on the best time to replace the vehicles. So let us see what will happen in case, for example, you decide to replace in year 1. So replace in year what? Year 1. So if you replace in year 1, we are going to have the year, then we have the cash flow, then we have the present value, interest factor, the cost of capital we are given, 10%, then we have the present value. So this is what we are going to have. Then we start with shillings are in thousands. And here shillings are in what? In thousand. We start with year 0. Year 0, how much did we invest?
7,000.
We invested 7,000. This is an outflow. 7,000 an outflow. Then we have year 1. We have decided to replace in year 1. How much will it be? You are going to take the cost that you incurred, then you raise the amount that you can resell what? The asset. The resale value is an inflow. The cost is an outflow. So it will be 4750 minus 500. Then you are getting an amount of how much? 4250. Then let us get this value. This is 1 plus r raised to negative n. So this will be 1.1 raised to negative what? Negative 1. So how much are we getting? Here we are getting an amount of 0.0909. This is what we are getting. This is what we are getting. Then from there, when we take this, we multiply by this. How much are we going to get? This times this. 4250 times what? 0.9091. So we are going to get how much? 3863.68. So we have used the formula. It is lump sum. Yeah, we are talking about lump sum. Where for us
that is
to get the
0.99. That is
9091. 091. Are you getting that way? 1.1 raised to negative 1. We get 0.9091. Are you getting this figure? 3863.68, 2 decimal places. Yes?
that 386. Which figure?
This one. 3863.
3863. 0.68.
That is what you are getting.
0.675. Huh?
You round up to 2 decimal places.
0.67.
Then we can get the NPV. So our NPV here, we are going to get how much? Negative what? So minus 7,000 plus what? 3863.68. Then we are going to get negative 36 point what? 0.32. Isn't it? Are you getting that one?
Yes.
Then from there, let us get the annual equivalent what? Or they have said equivalent what? Yeah, annual equivalent cost. How do we get the annual equivalent cost? Is NPV. Remember, this NPV was negative. NPV over what? Present value interest factor what? Annuity. R percent N. So therefore, in this case, our NPV 36 point what? 32 NPV present value interest factor annuity will be the same because we are talking about year one. So you divide by 0.9091 and our annual equivalent cost will be how much? It is 36.32. Then we divide by 0.9091. Therefore, we are having, I'm getting, and remember our shillings are in thousand, so I'm getting 34, then 4, 9, then from there, 2 decimal places, 920. When I write it in full,
Yeah.
itakuwa 920, isn't it?
Yeah.
Yes, that is what we are going to have. Then that is when you decide to replace in year one. Let us see if we decide to replace in what? Replace in year what? Year two. So again, you are going to develop the same table whereby here you are going to have year. Then from there we have cash flow. Then from there we have what? Present value interest factor, 10%. Then here we are going to have the present value. Shillings are given in thousands. Shillings are given in what? In thousands. Then we start with year 0. We invested what? 7. Then this is 1. Here you remain with 7. Then year 1. Now you are not reselling in year 1. You will resell in year 2. So you are going to incur the cost for the year 1. Na cost ni ngapi yenye utainika? Annual operating and maintenance cost. How much are you going to incur? You are going to incur from the question, not from the book, from the question. The past paper, December 2021.
Because natafuta hiyo kitu unaniamini.
From the past paper.
Year 2 sasa.
Yeah, year 1.
Year 1 is 0.
The replacement, sorry, annual operating and maintenance cost.
Or annual operating, year 1 is 500.
500, yeah? So we will incur a cost of how much? 500, and this factor 0.9091. Then we go to year what? Year 2. Get me the net cash flow of year 2. Take 35 minus 750. We are given that 500, year 2. The resale value minus 750. So we will get an inflow of how much? 2750. 2750 is our inflow. So you take the outflow minus what? Sorry, the inflow minus outflow. You are going to resell the asset 3500. Then you are going to incur a cost of how much? 750. So the net cash flow will be 2750, which will be an inflow.
Okay.
Then
That
this
is
factor,
year 2.
year 2. So this factor will be how much? 1.1 raised to negative what? Negative 2. And we are going to have 0.8264. 0.8264. Then let us get our present value. NPV itakuwa ni ngapi? Hii ni 500 times 0.9091. So here we are going to get 454.55, which is negative. And this one we are going to get how much? 2750 times 0.8264. You are going to get a positive 22, 72 point what? 0.6. And then we get what? Our NPV. So our NPV will be how much? So minus 454.55 minus 7,000. So our NPV will be 5181 point what? 95. Then from there we get annual equivalent cost, which will be the NPV. Remember, this is negative 5181.95. Then we divide by what? We divide by the annuity factor. How do we get the annuity factor? The annuity factor, remember the formula for us to get the present value, interest factor annuity, R percent, and years is 1 minus what? 1 plus R raised to negative n. You divide by what? You divide by R. That is the formula to give us that. The formula to give us that. So it will be 1.1 raised to negative what? Negative 2, 1 minus the answer. Then from there, you divide by 0.1. And we are getting 1.7355. 1.7355. So therefore, we are going to get our annual equivalent cost of how much? Our annual equivalent cost will be how much? It will be 5181.95. Then we divide by 1.7355. So in this case, we are going to get shillings what? 29.85. Then we have 8.50. That is what we are getting. That's what we are going to get. That is what we are getting in case we replace in year 2. If we decide to replace in year 2. So let us see what will happen in case we decide to replace in year 3. So replace in year what? Year 3. So what will happen if we replace in year 3? Again, we are going to have the year, cash flow, then present value, interest factor, then present value. This is what we are going to have.
So every year.
Then here we have what? We have shillings in what? In thousands. We have shillings in what? In thousands. So we are going to have 0, 1, 2, and 3. So cash flow itakuwa ni ngapi? Year 1 is 7. Whatever we invested, sorry, year 0. Here is 1. That is what we are going to have. Then year 1 we had 500, and the factor was 0.9091, and it gave us 454 point what? 55. Then we go to year 2. Year 2, the cost was how much? How much was the cost in year 2?
Year 2, the cost is the replacement cost 0.
Not replacement cost, annual operating and maintenance cost.
Okay. That one is 750.
Yeah, 7 what? 750, and the factor was 0.8264. Then from there, let us get the net cash flow for year 3. Net cash flow for year 3 will be how much? You cannot resell the asset unless you are reselling when you are replacing. Because if you say each year you are reselling, what will you be reselling? Let us assume in this year 1, you sold the asset, isn't it? In year 2, do you have an asset to sell?
No.
Yes.
Out upon
Then that's why in every final year, when you have decided to replace, that is when you will be reselling the asset or disposing the asset. So therefore, give me the net.
That is 2,000.
2,000.
That is year
3.
Year 3, 2,000.
Yeah, it will be 2,000. Then from there, let us get that factor. It will be how much? Remember, still we are talking about 10%. So therefore it will be 1.1 raised to negative what? Negative 3. Here we are going to have 0. What? 7513. And therefore how much are we going to have? We start from here. 750 times what? 0.8264. So therefore here we have 6 what? 19.8 negative. And then this one will be 2000 multiplied by 0.7513. Therefore here we are going to have 1502 point what? 0.6. 1502.6. And then from there give me the NPV. So the NPV will be how much? How much are we going to get as the NPV? So minus 619.8 minus 454.55 minus 7,000. So we are going to get, I'm getting 65, 71 point what? 75. Then from there?
Hii ni 1502.
Yeah, 1502.6.
You get
65, 71.75. Then we can get the annual equivalent what? Cost. Annual equivalent cost, you are going to take the NPV. Remember this was negative. So therefore it's 6571.75. Then we divide by the annuity factor 3 years. Annuity factor for 3 years. How are we going to get it? The annuity factor for 3 years
is
how are we going to get the annuity factor for 3 years? It is going to be 1.1 raised to negative what? Negative 3. Then from there, we divide by what?
2.4
divided by, 1.1 raised to negative 3. Then 1 minus the answer. Then from there, we divide by 0.1. So you are getting 2.4869. 4869. So therefore, we are having how much? 71.75. Then we divide by 2.84869. Then this one, you are going to get how much? You will get shillings to 26.42.540. 550. Because to 2 decimal places.
555.
550.
Huh?
550.
It is.
Because it will be 2642.55. Then the full amount will be 26,442.5.
Oh, because of the delay.
Yes. Then from there we go to finally replace. Replace in year what?
Year
Year 4. So again, you repeat the same thing. Here we are going to have the year. Then we have what? We have the cash flow. Then from there we have the present value interest factor, 10%. Then we have the present value. We have the present value. So therefore we start with
7,000.
shillings in thousands. Shillings in what? In thousands. So we have 0, 1, 2, 3, 4, and 4. So here we have 7,000. 1, 7,000. Then 2 we have 500, 0.9091. Then here we have 454.55. Then we have 750. Then here we have 0.82664. Then here we have 619.8. Yeah, negative. Then year 3 it will be how much? Was it 1,000 negative? The cost,
Yes, 1,000.
So therefore the factor was how much? 0.8. 7513. So here it will be 751.3. Then from there, we go to year 4. Year 4, give me the net.
250.
Net in 250. How much do we have?
2,000
Mm-hmm.
and 2,250. Annual operating in 2,000.
Yeah,
Residual
250.
value in 20.
So in front in 250. So the factor will be how much? 1.12. Or report 1.1 raised to what? -4. So we are getting how much? 0.6830.
Yeah.
So then 250 times 0.683. So we are going to get 170.
170.75.
Then we get what? The NPV. So our NPV will be how much? So therefore, minus 751.3 minus 619.8 minus what? 454.55. Then minus 7,000. Therefore, here we are getting
8654.9.
0.9. That is what we have. So then from there, let us get annual equivalent what?
Annual equivalent
Cost. So 8654.9 we divide by the annuity factor 1.1 raised to -4. 1 minus the answer. Then from there you divide by what?
0.1.
So we are getting
3.16.
3.1699.
3.1699.
So therefore, how much are we going to get? 8654.9. Then we divide by what? 3.1699. So therefore, we are getting shillings what? Shillings 27, 30,
27.30.
then 3,
3.38.
340, 340. In full amount. We round off to 2 decimal places and then we multiply by 1,000.
340.
Yes, that is what we have. So now we are done. What was the question? The question was asking about using the annual equivalent cost technique, advise Jasiri on the best time to replace the vehicle. Your advice. Yes. Sama. Sawa, acha nimalizie kazi. Yes. So what was the question?
Hii hatuko tumefanya hapa.
Yeah,
Haiko kwa kitabu.
it is there. What was the question? The question was asking, using the annual equivalent cost technique, advise Jasiri Limited on the best time to replace the vehicle. So which is the best time? Where the cost is the lowest.
Where the cost is the lowest.
Yeah, because we are talking about the cost. If it was the NPV, where it should have been the highest. So this one is 34. That is this one is 29. This one is 26. This one is
26.
27. So therefore the decision is, decision will be replace
At year 3.
replace after every 3 years. Yeah, you replace after every 3 years. That it will be the
Now, can
decision.
they replace after year 3? You're wrong.
Yeah, you are replacing. So they should replace after every 3 years. After every 3 years. So that should be the advice.
FM. Hii unasema ilifanywa sio?
Tumesema
Kwenye kitu unarudi nyuma. Umesema umechoka, unaanza kukifuta takula kitu kula. Kesho ni saa ngapi?
kesho ni afternoon.
Or at least kuna nini? Sasa niko na website kama ni kuna kazi zingine unataka kufanya ukitoka Ukitoka kula kuna class unaendelea.